So are we going to see a way to trade the slump in China now that their stocks are just a hair from possibly the worst year in decades? Or is there just no more chasing this move as we move forward? That is, of course, the question on our minds today. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. We got another awful set of Chinese economic numbers overnight. And so today we are going to focus on what is actually going on in this economy now that we're about a year removed, in fact, almost exactly a year removed from their reopening following COVID-19 lockdowns that had them hobbled in near total quarantine for much longer than other major economies, and consider what the next steps are, and then land on how to actually trade it. Because the amount of pain that has already been factored into Chinese stocks has been nothing short of emphatic. And so looking for opportunities to take advantage of what comes next isn't as clear-cut as it might seem. So let's first consider here what it is that the trouble looks like, what it is that the data showed us overnight, and then try to see where an actionable opportunity in all of this might emerge, if not Chinese equities themselves. So the numbers that crossed the wires here were the official set of PMI numbers for November. This is from the CFLP, China's Federation for Logistics and Purchasing. So this is government data, Beijing's data. There's going to be a set of analog numbers from the private sector, from Caixin and S&P Global, and they're going to be published over the weekend here. The manufacturing data will come out later this week, but the full picture, composite and services, are due early next week. And partially over the weekend. So we'll see how that stacks up to this, but the divergences are usually nominal at best. So the direction here, clearly one of concern, and the private sector numbers are not going to look meaningfully better or tell a meaningfully different story when they cross the wires. So we have here a situation, clearly, as we can see, where growth bottoms in December of 2022. This is, of course, as ever, in the logic of PMI numbers, which means that 50 is neither growth nor expansion. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so we can see that the bottom in the pace of contraction is December of last year, and that, of course, is no surprise. That's the month where China finally throws in the towel and says the zero COVID policy isn't working. We have to reopen the economy. At this point, we're getting riots. We have to do something. And so you then get a pop. We can see here that the pop is much greater in services, the orange line here, than it is in manufacturing. That's the red line. And we'll get to why that is in just a moment. But there is this pop in services, and that helps to drag the overall economy, the composite index there in the dark gray, upward to see some of its fastest growth in quite some time, and then everything crests by March. So to kind of make this a simple narrative, you, of course, let out China's enormous population out of lockdown. They're going to start moving around and going to restaurants and traveling, and that's going to give you a pop in the service sector. There's a very easy sort of story to tell there. For manufacturing, you are dependent on global demand. And when you are China, which until the pandemic was the go-to value add center for the global supply chain, where raw materials and semi-finished goods would come to China, they had the abundant labor. They would use that to turn those raw materials and semi-finished goods into finished and more finished goods, and then ship them on off to wherever they're going to be finished, or if they're already there, then sold. Usually, of course, that's going to be in Western markets where most rich consumers live. So the US, Western Europe, and then, of course, to some extent, the adjacent markets. So Canada, Japan, et cetera, et cetera. And so when you look at all of this and you see, well, manufacturing has a bit of a pop as the economy is basically turned back on, but it never really gets off the ground. It slumps promptly back below 50 and spends most of the past year in contraction territory. You start to see what exactly is going wrong in China's economy. So this right here is a bit of a comparative view. So the red line is Chinese composite PMI, the green is the US, the blue is the Eurozone. And of course, these are China's top two trading partners by a long mile. So what you see here is growth in both coming out of COVID crests more than a year before China reopens for business. And that's both catch-up growth after those economies reopened. There's, of course, a speed up in activity inherent there. And likewise, the impact of very aggressive stimulus in both of these economies. Not just monetary, of course, but much more potently fiscal stimulus, which actually creates demand, creates spending, and creates economic activity. By comparison, low interest rates, so monetary policy, they can encourage activity, but they don't actually make demand. Fiscal policy does. And so what you have here is a situation where China, by the time it reopens, is already reopening into a vastly weakened environment where, on the one hand, it's been closed for so long that these key markets have been busy for a year and a half, rejiggering their supply chains to be less China dependent. On the other hand, the amount of demand coming out of these economies for anybody is inherently diminished, both by aggressive rate hike cycles, which kick off in early 2022 in both areas, and on top of that, of course, the fading of stimulus past and the running out of sort of the post-reopening jump in both cases. In the US, it crests a bit sooner. In Europe, it crests a bit later. So China is reopening into a situation where not only is there less demand, its piece of the less demand is smaller. And so if you look at global volumes of trade and China's share of them, since peaking just around the beginning of COVID at 15.1%, by the time you get to about the middle of this year, you're down to 12.7%. Now, that's 12.7% of the whole of global trade. So it feels like a small difference of just over 2%. But when you consider that it's just over 2% of the entirety of global trade, this is a tremendously huge shift in actual money terms. Furthermore, you can see that the pace at which the trade picture in China has been deteriorating versus the world, it's generally been deteriorating faster. as of the latest numbers. We can see here year on year down 14.5% in China, and having started sooner, only about 8.8% down for the world as a whole, China inclusive. So the degree to which other economies have dramatically outperformed here is significant. And so the situation going forward is an interesting one, because on the one hand, we have very anemic economic growth conditions, and not an easy way to undo them, because it looks like lasting damage has been done. Supply chains have shifted, and the overall situation looks like it's biased toward less growth in the near term, not more. So the demand pie looks like it's going to get smaller, even as China's share of whatever pie that there is has been reduced, maybe in a permanent way. Here's where we are on the state of the global pie. So these are October numbers. We don't have November numbers for the global PMI just yet. We will early next week. But we already see that as of October, the global economy has stopped. The composite index is squarely at 50. That means the global economy is neither growing nor shrinking. We know from the PMI numbers that we've already seen out of the US and the Eurozone, we're not going to get a meaningful improvement from those areas. They looked a little bit warmer if we looked at the US, not so much if we looked at the Eurozone. There's still almost certainly a recession there that's ongoing now. Once we factor in the data out of China that's just come out, when the new catch-up global numbers come out next week, this picture will look possibly worse, not better. So we're already at standstill here. This is not a situation where China has so much global pie left to capture as we look out into the coming year. What's more, the Fed has told us that there's about a 12 to 18 month lag in how its interest rates get absorbed into the economy. So when you hike rates or you cut them, it takes about 12 to 18 months for the change to fully reflect in the real economy. That's an average of 15 months. If we guesstimate then that there's about a 15-month lag between the start of the Fed rate hike cycle and when the pain from it has been fully absorbed, we're not even halfway through. We still have about 300 basis points worth of rate hikes to fully on board. We're only about 45, 47% of the way to actually seeing all of the pain from the Fed's tightening actions be reflected in growth. And so with that in mind, of course, the Fed has signaled that it's probably done raising rates and that we're on autopilot now to let what tightening there is still in the pipeline to continue to have its effect. But from a growth perspective, what that means is that the situation is going to look weaker, not stronger going forward. So if you're China and you're dependent on this demand, it's not looking very good. As a matter of fact, avoiding a recession next year in a global way seems devilishly difficult of a proposition. If we consider what global growth is made of, we can see here a very troubling situation. So 22% is the US, 12% is Europe, 16% is China. So together, that's 50% of global GDP. Now, we can see from these latest numbers here, the US and China are at standstill and the Eurozone is shrinking. And that's 50% of global GDP. Now, it's actually a little bit more, and maybe quite a bit more, because like China is dependent on the US and the Eurozone to a large extent, the rest of world 50% that you see in the gray here is dependent on the three major economies. They're generally vendors for demand from those three, be it Australia, New Zealand, and a lot of the other commodity producers for China, be it Central Europe for the Euro area, the Nordic economies for the Euro area, or be it Canada or Mexico, let's say, for the US. So a huge part of what's happening in that other 50% is actually dependent on what happens in the US, the Eurozone, and China. And so their influence is even greater than this suggests. So there's very little chance, it seems, that we're not going to see a global recession next year, if this is the way that the table is set. So for China, being that it lives at the middle of the global supply chain, and that the problem with its reopening has fundamentally looked like the absence of demand and then the edging out of China as a participant to a lower share of that demand, we ask ourselves, well, if that's what's going on, then the pain for China is going to continue. So how does one actually trade that? And this is where things get a little dicey. Because if we look at the way that Chinese stocks have performed relative to everything else, they've already suffered a tremendous amount. We have here the large cap ETF, FXI, in the orange, the more broadly based ASHR, which is a tracker of the CSI 300. And when we put all that together, I mean, they're down 11%. That's almost certainly a huge reason why the emerging market ETF here in the gray, EEM, is up only 4% on the year, whereas that same ETF excluding China, EMXC, is up 11%. The all-country world index is up 15. The U.S. is up 19. And one of the biggest sore spots making the difference between 19 and 15 for the U.S. and the world is, in fact, China. So when we look at this, the natural question is, well, how much more pain is there to price into these markets? Or has the preponderance of bad news already reflected itself in this anemic performance? There is some credence to that argument. If we take a look at the way that Chinese economic data has performed relative to forecasts, we can see that from about mid-July, we start to see improvement relative terms, of course, not absolute, as we just saw. Chinese economic data looks awful. But when we look at it relative to expectations for how it might come out, it has improved. And we can see again that that starts about mid-July, second half of July. We can see that the recent pause in that dynamic, now that the data is actually tending to outperform relative to forecast, as we can tell by the surprise index having gone back above zero, the pause begins toward the end of October, the beginning of November. So what is going on here? If the data isn't getting better, why is it getting better in relative terms? Well, it seems like the baseline has moved. So indeed, we can see here that expectations for Chinese economic growth have been vastly diminished since the second half of July. and that a bit of a correction higher begins, shock of shocks, end of October. So it's expectations themselves that have been pulled down. And so it's become easier for the data to beat against those expectations. It's not that the situation is getting better. It's that the markets are pricing in the bad news. So the question becomes, well, now that Chinese stocks are down 11% and everything else is up by that or more, does it actually make sense to bet against Chinese stocks? When there is seemingly evidence that the markets have adjusted their expectations, that the data is not good but isn't worse, and there isn't necessarily then a natural catalyst to go from, let's say, the 11% loss that we're angling for this year to another big loss next year. That may very well be what happens. But to chase it here without evidence that necessarily moves the narrative in a more negative direction seems like a stretch from a risk-reward perspective. A lot of losing has been already done by Chinese stocks, accounting for precisely this state of affairs. There is an opportunity, however, outside of the equities market, and it seems to be with the Australian dollar. So we can see here, the Australian dollar has had a good month, generally speaking, in November. We can see here from the bottom of the U.S. dollar upswing here in late October, the Australian dollar has done a fairly good job. It's looking still quite strong despite this recent pullback. And it seems to have that here really as a function of what's going on in broader financial markets. So if we look at what's been happening there, this is that same all-country world index ETF that we just saw on the previous chart comparing economic performance against stock performance. So when we were looking at this chart right here, the purple line that you see on there, that's the all-country world index. So all global stocks, the MSCI index of global equities writ large, all the geographies all together. When we take a look at how that is doing here, clearly it's had an emphatic November. And the Australian dollar has largely mirrored that story. Now, why is that? Well, first of all, this is almost assuredly what's going on with global stocks. We've talked about this before at length. We'll summarize it here by saying clearly, as the amount of rate cuts expected out of the Fed diminished, that's the gray bars getting higher here, between December of this year and December of next. So in other words, the stock of rate cuts on deck for next year, as expected by markets, started to diminish mid-year, and into about the end of October, stocks were falling because higher borrowing costs mean that financing any kind of economic activity, certainly for public companies, is going to be more expensive than earlier expected. Once it becomes the consensus that actually that process has stopped, and now the cost of borrowing might be lower because more and more rate cuts start to once again enter into the forecast, stocks surge. Because the US dollar is the quintessential currency of global commerce, doing this has global implications, not just for the US. And so, yes, this means lower borrowing costs in the US, and so US stocks are understandably doing well against this backdrop. drop, it also means that you get a decline in the US dollar. When interest rates look more favorable for the dollar, that is higher, which is a greater return on holding the currency, the dollar goes up. When it's time for the currency to come down is when you get this turn in policy expectations and more rate cuts come in. Now, that also means that borrowing dollars outside of the U.S. becomes cheaper. And because of the dollar's ubiquity, that means borrowing in general, financing of economic activity in general becomes cheaper. And so, not surprisingly, against this backdrop, global stocks are surging. And of course, the dollar's weakness also means that the Australian dollar, a growth-sensitive sort of creature, and of course, one that has the US dollar just mechanically on the other side of its exchange rate here, it goes up within the same dynamic. Now, Australia looks to China as its largest trading partner, and that's been the case since 2007. It has been undisturbed despite the fact that Canberra and Beijing haven't exactly gotten along great in recent years, although they're attempting to make an effort at mending fences recently. So there is a very strong sensitivity for the Australian dollar to China's business cycle. Once we get through the part of this story where the Fed policy outlook, as displayed here, is absorbed to some significant extent, and optimism begins to look for a new catalyst, it might have to forego the reins and give way to bears as this global recession comes into view. And that, of course, isn't good news for stocks, but it's also, pointedly, setting up a reversal for the Aussie dollar. And of course, the China story becomes a huge component here, both because of the Aussie sensitivity to China and because of China's importance for global growth, and of course, because of the parallels across both narratives. Not only is the Aussie outsized sensitive to China and therefore to any global downturn that hurts China, it also has underlying it the US dollar's sell-off, which has room to correct the other way if global recession becomes the focal point. And we start to see a risk-off move out of assets into cash. And of course, that cash of choice is the most liquid one, and that again gives us US dollar gains. So in trading China's weakness, which isn't likely to go anywhere fast and might actually become worse as the months come in, the vehicle to do that might well live in the currency markets, where there is some relative strength to bet against, rather than Chinese equities, where a great deal of pain has been suffered as it is. And that is Macro Money for today. This is our last show for the week, of course. We're here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at what happened on Wall Street and what it means going forward. I'll be back on with Chris for Futures Power Hour tomorrow, as I am every Friday, on with Tom and Tony for First Call on Sunday, writing for the News and Insights section of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money will be back next week. Happy trading.